So what exactly is proprietary trading or prop trading? It's a concept that's a point of debate and is still an unsettled part of the Volcker Rule. Under the current draft, the rule prohibits banks from making bets that will put their own capital at risk, but it makes exceptions for legitimate hedging practices. But exactly what are these practices? This has yet to be determined. In my interview with Congressman Barney Frank yesterday, I raised this very issue. The problem with the Volcker Rule is you can't define it. What is proprietary trading and what is acting on behalf of the customer? Really? How?
You can define it. The fact is that the banks tried to make it more complicated than it is. Most of them know what they're doing in their own internal accounting. They know when they're doing it to make a profit for themselves. They're not blindly moving around. And if you do it tough, and as I think we should now be doing after what we saw with J.P. Morgan Chase and elsewhere, losing all that money. So
you're going to leave it to the banks, and you're going to leave it to the banks to tell you, oh, this was proprietary trading, this was acting on behalf of the customer.
If you want to have a serious conversation, let's have it.
I want to have a serious conversation.
No one is saying
I'm just trying to figure out how to define Volcker Rule.
The regulators will define it. This notion that we're going to leave it to the banks, I don't know where you got that. Nobody is suggesting leaving it to the banks.
You just said it. You said the banks know what they're doing. The banks know when they're making a profit for themselves.
I said that. Excuse me, Maria, but you got to follow what you've said. You said to me it's impossible to tell the difference. My refutation to you is no, it's not impossible to tell the difference. The banks know very well when it's what's what. I said that. I'm sorry. Please let me finish.
Yes, of course. Go ahead.
You're kind of mocking this in an inappropriate way, I believe.
Not at all.
What I was trying to do was refute.
So, is it the congressman right? Do banks know how to define it, or is the rule still too blurry? Joining us right now, Andrew Stoltmann of Stoltmann Law Offices. He says the banks are, in fact, playing dumb, as Congressman Frank claims. But Ken Benson of the Securities Industry and Financial Markets Association disagrees. You know, my point, Andrew, is the fact that, let's say, humor me for a moment and let me explain this. Let's say a big customer comes to you and you are, whatever, J.P. Morgan, and a big customer comes to you and says, I've got 3 million shares of IBM to unload. What are you going to do? You are the bank. You have to take that business because that's what you do. You're going to buy that IBM stock from this client, okay? You're going to have that IBM stock, and of course you're not going to dump it all on the market immediately. You're going to find your spots, the best price. Maybe you'll sell some today. Maybe you'll sell some tomorrow. Maybe you'll sell some next week. You're going to look for the best price. So when you sell it tomorrow, is it proprietary trading, or are you acting on behalf of your customer?
That's a good question. I mean, I think in
that is the question.
Well,
that's prop trading.
Yeah.
That's the question. So what is it?
Well, I think proprietary trading is clearly trading done for the benefit of the firm instead of the customers. And I know what you're getting at. And unfortunately, the entire market-making exception and things like that are simply the way the securities industry is going to try to get around the prohibition under Dodd-Frank and specifically the Volcker Rule. And hey, Maria, I'm just happy that you're not mocking me like you were mocking Barney Frank yesterday.
Andrew, I wasn't mocking Barney Frank.
I know you weren't. I know.
Ken, you point out that prop trading, this ban, cannot be implemented on a one-size-fits-all basis. Explain your point.
Well, I think you hit the point really quite well. First of all, we need to understand that Congress was very clear and very explicit in exempting market making and hedging because they understood the importance that having deep and liquid U.S. capital markets is to the U.S. economy. And so you're right, it is very hard to define, and I think that's evidenced by the fact that the regulators who are tasked with writing this rule asked 1,300 questions. They are having a very difficult time trying to define between what is pure proprietary trading, trading for one's own account, and market making and hedging. And how you do this will be very difficult. It doesn't just apply to equities the same way it applies to fixed income, to derivatives, to commodities, and the like. So it's a very difficult question.
So that's, that was my point, Andrew. If you can't define what it is, and you can't define if, on the one hand it's prop trading or on the other hand it's just acting on behalf of your customer, how do you regulate it? How do you even write it?
Well, look, I mean, we have a number of regulatory bodies looking at this issue, and I'll give you the fact that, yeah, it's hard, but I also have a problem, though, with the banks playing dumb, pretending like they don't know what proprietary trading is. Of course they do. They have to know it because they have to manage their internal risks. And by claiming that, gee, we're so confused by Dodd-Frank and we don't know what's going on, I just don't think think it passes the red face test.
Well, it's interesting. On the one hand, the industry is accused of playing dumb. On the other hand, the industry is accused of delaying by following the Administrative Procedures Act to try and inform the process, file comments under the rule and comment process that has been the standard of law for tens of years. The fact remains that institutions repeatedly, since the passage of Volcker, have gotten rid of their proprietary trading desk. The real question comes down to what is the market-making exception going to be? What are the rules that are going to apply to market-making going to be? What are the rules going to be that apply to risk management? And what are the consequences as to how those rules are drawn?
But Maria, why are we even listening to the securities industry and to groups like SIFMA? After 2008, after the J.P. Morgan $4.5 billion loss, they should be shut out of the equation. I don't care what they think. I don't care what their position is. Well, it'd be hard to shut them out of the equation
because, first of all, that's the way our democratic process works. That's the way the Administrative Procedures Act works.
Things change a little bit after you almost melt down the global worldwide economy. So at that point, I don't think we need to listen.
But I don't think we suspended the Constitution.
Of course we did. Nobody said we have.
I don't think that's what you're arguing that we do. The fact of the matter is, if we don't do this correctly, we will damage U.S. capital markets. We'll take liquidity out of the markets.
Worse than what happened in 2008?
And the costs will come out of people that access the market. The companies that issue stock and debt in the markets, the investors, everyday savers who buy those securities. All the data. And that's why you've seen comment after comment, not just from the dealer side, but from investors, from mutual fund companies, from issuers of stock and debt, that they are concerned about how this is done because it will come out of their hide if it's done incorrectly.
Let me get your take on what Jamie Dimon told us, because the CEO of J.P. Morgan was on CNBC in June. He told us why he thinks that the line on prop trading is blurry. Take a listen to this. I want to get your reaction.
I think you could draw a bright line against what people used to call prop. If I hire you, I put you in a corner, you don't do customer business, use a balance sheet, and you just try to arbitrage. I could put a bright line behind that. What I can't put a bright line behind is when you say proprietary, so I get asked all the time, if you made or lose money on this, that just shows. That's true for every loan we make. That's true for every security you buy.
Andrew, what's your take?
Marie, there are ways to do it. I mean, if you take a look at the trading desk and you take a look at the positions held at the end of the year, if you are truly, for example, engaging in market making, you should see positions that are held 2 days, 5 days, maybe 10 days, as opposed to if you're speculating for your own account, these positions are going to generally be held much, much longer. So again, I have the problem with the securities industry playing dumb. I have the problem with us listening to SIFMA and listening to the securities industry telling us what we should do after what they did in 2008, we're still feeling today.
Well, Andrew, you probably haven't ever spent any time on a trading desk, but if you did, you would know that there's a difference between different types of assets. And Maria actually laid this out quite well in her opening comments. If you're talking about stock, there are 7,000 different stock issues in the United States, but there are about 40,000 different bond issues or fixed income issues. So there's one IBM stock, but there are probably 100 or more different IBM debt instruments that are out there.
But stocks
so they don't all
bonds
trade in the same volume and in the same tenor and time. The market making is a very difficult process. But you are right about one thing. The fact of the matter is that you can go back and look at the end of the day. You can go back and look at the end of the week. And the law provides the regulators the ability to do it. So let's write a rule that allows the markets to work appropriately for the benefit of issuers and investors. And the regulators have the tools to come back and say, we don't like the way you did this, and correct it.
All right, we'll leave it there, gentlemen. Great conversation.
Right.
It's a very good, important debate to have as we await the rulemaking writing of Dodd-Frank to be